Welcome to the Single Family Housing Direct Division training on the native CDFI Relending Demonstration Program loans to ultimate recipients. This presentation will provide information to help administer the native CDFI Relending Demonstration Program. The Native Community Development Financial Institution Relending Demonstration Program provides mortgage lending capital to native CDFIs. These demonstration program loans are then passed through to eligible mortgage loan recipients living on tribal lands. The program is designed to improve home ownership opportunities to Native American tribes, Alaska Native communities, and Native Hawaiian communities in rural areas. Loan funds must be used to provide direct loans made to eligible ultimate recipients in accordance with 7 CFR 3550. However, the loan decision is ultimately the NCDFI's. Loan funds must be used to provide direct loans to eligible ultimate recipients to buy, build, rehabilitate, improve, or relocate an eligible dwelling on tribal land. Listed here are the regulatory requirements that apply to NDCFI loans made to ultimate recipients. Information on each topic will be presented on the following slides. In addition to acquisition, construction, repairs, or the costs of relocating a dwelling, loan funds may be used for reasonable expenses related to obtaining the loan, including legal, architectural and engineering, technical, title clearance, loan closing fees, appraisal, surveying, environmental, tax monitoring, and other technical services. The cost of providing special design features or equipment when necessary because of a physical disability of the applicant or a member of the household. Reasonable connection fees, assessments, or the pro rata installation costs for utilities such as water, sewer, electricity, and gas for which the borrower is liable and which are not paid from other funds. Reasonable and customary lender charges and fees if the loan is being made in combination with a leveraged loan. Real estate taxes that are due and payable on the property at the time of closing, and for the establishment of escrow accounts for real estate taxes, hazard and flood insurance premiums, and related costs. Packaging fees as outlined in 7 CFR 3550.75. Any NCDFI charged packaging fee may not exceed the maximum fee allowed in Handbook 1 3550, Attachment 3A. Purchasing and installing essential equipment in the dwelling, including ranges, refrigerators, washers, or dryers, if these items are normally sold with dwellings in the area and if the purchase of these items is not the primary purpose of the loans. Purchasing and installing approved energy-saving measures and approved furnaces and space heaters that use fuel that is commonly used, economical, and dependently available. Providing site preparation, including grading, foundation plantings, seeding or sodding, trees, walks, yard fences, and driveways to the building site, and for reasonable fees for homeownership education. Such fees may be added to the loan amount in excess of the area loan limit and appraised value of the house. Loan funds may not be used to purchase an existing manufactured home unless eligible under an existing pilot program or made eligible through a change in program regulations, to purchase or improve income-producing land or buildings to be used primarily for income-producing purposes, or to pay fees, commissions, or charges to for-profit entities related to loan packaging or referral. Please note that existing manufactured homes are eligible in some states if they meet certain criteria, which we will discuss on the next slide. We currently have a pilot program in some states for manufactured homes constructed on or after January 1st, 2006, that would allow for them to be funded with an NCDFI loan. If the property is not located in a pilot state, loans can only be made for new manufactured homes purchased directly from manufactured home dealers. Homes that are less than 12 months old and never occupied are considered new. The site development work, the manufactured home, transportation and setup costs, as well as the purchase of the site, if not already owned by the applicant, can all be financed. Income eligibility. At the time of loan approval, the household's adjusted income must not exceed the applicable low income limit for the area. Income limits are updated annually and can be found on the eligibility website. Citizenship status. The applicant must be a United States citizen or a non-citizen who qualifies as a legal alien as defined in 7 CFR 3550.10. Principal residence. Applicants must agree to and have the ability to occupy the dwelling as their principal residence. Legal capacity. Applicants must have the legal capacity to incur the loan obligation or have a court-appointed guardian or conservator who is empowered to obligate the applicant in real estate matters. Suspension or disbarment. Applicants who have been suspended or debarred from participation in federal programs are not eligible for a loan. This is one item that rural development will have to check through our Do Not Pay portal because NCDFIs cannot be given access. It will be important for the NCDFI to contact the state office when taking a loan application so the portal can be checked. If the applicant has a hit on the portal, loan making must stop until that issue can be cleared. Repayment ability. Repayment ability means applicants must demonstrate adequate and dependently available income. The determination of income dependability will include consideration of the applicant's history of annual income. Credit qualifications. Applicants must be unable to secure the necessary credit from other sources on terms and conditions that the applicant could reasonably be expected to fulfill. Applicants must have a credit history that indicates reasonable ability and willingness to meet debt obligations. An applicant with an outstanding judgment obtained by the United States in a federal court other than the United States Tax Court is not eligible for a loan. When considering creditworthiness, both the recipient's ability and willingness to meet their debt obligations must be reviewed. Ability refers to reliable income and considers whether the recipient has adequate income to repay their debt obligations from stable income sources. Willingness, on the other hand, means that the recipient not only has the funds available, but is willing to use those funds to pay their creditors. In other words, you could be a millionaire with more than enough ability to pay your bills, but if you choose not to pay those to whom you owe debts, then you don't show a willingness to do so. Both components, ability and willingness to pay, are critical to the credit analysis. Additionally, a review of the credit history of all parties of the note is required. A full credit review is required to determine if there are any indicators of unacceptable credit when the applicant's credit score is below 640, if there is only one or no credit score, or the applicant has a score of 640 or above, but has a significant delinquency or an outstanding judgment in federal court. The loan originator must investigate indicators of unacceptable credit to determine whether they are accurate and whether there is an explanation for the problem that might justify an exception. Failure to understand the nature of the credit problem could put the NCDFI at risk of providing financing to a recipient who is unable or unwilling to repay the debt, or could cause the recipient to be rejected for a loan based on inaccurate or incomplete information. Indicators of unacceptable credit include little or no credit history. The lack of credit history on the credit report may be mitigated if the applicant can document a willingness to pay recurring debts through other acceptable means, such as third-party verifications or canceled checks. Third-party verifications from relatives or household members are not permissible. Payments on any installment account on a per-account basis, not cumulative of any and all of these account types, where the amount of the delinquency exceeded one installment for more than 30 days within the last 12 months. Payments on any revolving account on a per-account basis, not cumulative of any and all of these account types, which was delinquent for more than 30 days on 2 or more occasions within the last 12 months. A foreclosure that has been completed within the last 36 months, an outstanding IRS tax lien or other outstanding tax liens with no satisfactory arrangement for payment, 2 or more rent or mortgage payments paid 30 or more days late within the last 2 years, if the recipient has experienced no other credit problems in the past 2 years, only 1 year of rent history is evaluated. Outstanding collection accounts with irregular payments or no satisfactory arrangements for repayment, or collection accounts that were paid in full within the last 6 months unless the recipient had been making regular payments previously. Non-USDA debts written off within the last 36 months unless the debt was paid in full at least 12 months ago. USDA debts that were debt settled within the last 36 months or is being considered for debt settlement. And lastly, delinquency in a federal debt. Remember that each recipient is evaluated on their own merits. A recipient with an acceptable credit history cannot compensate for a co-borrower with an adverse credit history. The analysis of credit determines whether the recipient has an ability and a willingness to repay obligations. The following will not be considered indicators of unacceptable credit. A bankruptcy in which debts were discharged more than 36 months prior to the date of application, or where the recipient successfully completed a bankruptcy debt restructuring plan and has demonstrated a willingness to meet obligations when due for the 12 months prior to the date of application, is not considered unacceptable credit. A judgment satisfied more than 12 months before the date of application is also not considered unacceptable credit. First-time homeowners and recipients who have not owned a home in the past 3 years are required to complete homeownership education. Required homebuyers should be encouraged to complete homeownership education training as early in the application process as possible, since the training will prepare them for shopping, buying, financing, and owning a home. Encourage recipients to take free homeownership programs if available. Upon completion of a homeownership education course, a letter or certificate of completion will be issued. The certificate is valid for 2 years. The CDFI may grant an exception to the homeownership education requirement for individuals in geographic areas within the service area where the CDFI verifies that certified homeownership education is not reasonably available in the local area. A conservative approach to the exception provision is recommended, as all efforts to have recipients undertake homeownership education early in the process are generally encouraged to gain maximum benefit. In the next portion of the training, we will focus on the income calculations and assets. The loan originators use income information to help determine whether the recipient is eligible for a loan, to calculate the recipient's ability to repay the loan, and to determine the loan amount for the household. The loan originator should review income 3 different ways. Annual household income is the income of every adult household member who will be occupying the property for all or part of the next 12 months. Adjusted annual household income applies allowable deductions to the annual income figure to arrive at the household's adjusted income. Adjusted income is the amount used to determine program eligibility. And repayment income is the third income calculation, and it is used to determine a recipient's purchasing power, or in other words, the maximum loan amount. Annual income is the income of all household members from all sources except those specifically excluded. This includes any benefits that are received on behalf of minors. For any adult full-time students who are not party to the note or spouse of the applicant, only the first 480 of earned income is counted. An applicant must provide their 2 most recent signed copies of their individual and business tax returns filed with the IRS and all supporting schedules. If the applicant does not have copies of their tax returns, or there are inconsistencies in what is provided by the applicant, the CDFI should ask the applicant to directly request, obtain, and provide copies from the IRS using IRS Form 4506T, Request for the Transcript of Tax Return. Income generated from non-retirement assets must be included in income calculations. Annual income is all the amounts that go to or are received on behalf of the applicant, co-applicant, or any household member, and all amounts anticipated to be received during the next 12-month period. If the recipient earns or has overtime, bonus, or commission, this must be included unless you can document with certainty it will not continue. Annual income is the basis for computing adjusted income. Income sources to be excluded from the annual income calculation include earned income of persons under the age of 18 unless they are a borrower or a spouse of a member of the household, payments received for the care of foster children or foster adults, amounts granted for or in reimbursement of the cost of medical expenses, earnings of each full-time student 18 years of age or older except the head of household or spouse that are in excess of $480, temporary, non-recurring, or sporadic income including gifts, lump sum additions to family assets such as inheritances, capital gains, insurance payments under health, accidents, or workers' compensation policies, settlements for personal or property losses, and deferred periodic payments of supplemental security income or Social Security benefits received in a lump sum, any earned income tax credit, adoption assistance, amounts received by the family in the form of refunds or rebates under state or local law for property taxes paid on the dwelling, amounts paid by a state agency to a family with a developmentally disabled family member living at home to offset the cost of services and equipment needed to keep the developmentally disabled family member at home, the full amount of any student financial aid, and any other revenue exempted by a federal statute. Each recipient must provide the income, expense, and household information needed to enable the NCDFI to make income determinations. Recipients should be requested to provide 2 years of history for a reasonable determination of income. However, the determination required will vary with the source of income. In most cases, the loan originator should compare the information provided with the tax returns, W-2s, and other verification sources to evaluate the 2-year history and make a determination if their income is stable and dependable. Verifications are typically valid for 120 days and up to 180 days for construction loans. However, pay stubs cannot be more than 60 days old at the date of application submission. Pay stubs should be provided for the most recent 4 pay periods. Verification documentation must be valid at the time of eligibility, loan approval, and loan closing. The 4 income calculation methods are used to project expected income for the next 12 months include straight-based, average, historical, and year-to-date. The final 12-month projection will be based on a comparison of the 4 methods and analysis of the figures to determine which is the most representative of income likely to be received during the next 12 months. If a certain income calculation method is not applicable, such as the case for Social Security income, the rationale should be clearly explained in the calculation comments. If the figures are disparate and one figure is clearly the most representative, an average of the resulting figures may be used. Selecting the lowest figure without analysis is not acceptable. The selection must be carefully deliberated and may require additional verification. USDA has a worksheet for computing income that can be used by the NCDFIs to assist in completing income calculations. We will go through examples of the income calculation worksheet in the upcoming slides. The worksheet for computing income and max loan amount calculator is located on the Direct Loan Application Packager's website. Please keep in mind that this worksheet will only be used to show income calculation and not determining eligibility because the worksheet uses the 502 program subsidy rates. Let's take a look at an example to see how the worksheet for computing income actually works. In this scenario, Ken Anderson has worked for B&N Auto for the last 2 years. According to the application, Mr. Anderson reported that he earns $10 per hour, works 40 hours per week. Since Mr. Anderson is paid weekly, he submitted his last 4 pay stubs through the pay period ending May 1st that show gross pay, including overtime, of $460, $415, $475, and $445. His most recent pay stub reflects gross year-to-date earnings of $5,885. Mr. Anderson's tax return for last year showed gross wages of $16,640. The straight-based income calculation converts the recipient's gross benefit or wage to the annual equivalent. In this example, Mr. Anderson earns $10 per hour, works 40 hours per week, and is paid weekly. Plugging that data into the calculator results in an annual amount of $20,800. The income method is typically best used when the applicant has a fixed salary or is a fixed wage with fixed number of hours and typically does not have overtime or bonus income. This slide demonstrates common scenarios for calculating annual income using the straight-based income calculation. With this calculation, the recipient's amount of pay is multiplied by the number of times the pay is received in a year. For a recipient paid at an hourly rate, multiply the rate by the number of hours per week by the number of weeks in a year. For recipients paid monthly, multiply the income per month by 12 months. If the recipient is paid weekly, multiply the income per week by 52 weeks per year. Moving back to the example of Mr. Anderson's income, the average income calculation method averages the gross benefit or wage for last 30 days, then converts the income to its annual equivalent. In the example, the applicant is paid weekly, so 4 weeks are used to obtain an average, then multiplied by 52 weeks. For biweekly payments, the 2 biweekly amounts would be entered and divided by 2 to obtain the average amount, then multiplied by 26 pay periods to annualize. This method is helpful in situations when the hours fluctuate, the income includes piecemeal work, or the income includes bonus or overtime that varies. This income method is typically best used when the applicant has a fixed salary or a fixed wage with fixed number of hours and typically does not have overtime or bonus income. The year-to-date income calculation uses the recipient's year-to-date gross earnings divided by the number of calendar days elapsed between January 1st of the current year and the last date covered by the pay stub, and then multiplied by 365 days. In the example of Mr. Anderson, income verification was obtained through May 1st. January 1st to May 1st is 121 days. To annualize income based on earnings year-to-date, divide year-to-date earnings of $5,885 by 121 days, then multiply by 365 days. The result is annual income estimated at $17,752. Note the date calculating tool indicated by the red box on the worksheet is used to calculate the number of days. The start date is January 1st or the date the applicant began their employment in that year. The historical income calculation is simply looking at what was reported last year to the IRS. This calculation considers gross income before any deductions for things like retirement accounts, flexible spending accounts, healthcare plans, etc. For historical, any declining income trend, especially for repayment income, must be carefully documented in the income analysis. As shown on the slide, Mr. Anderson's tax return for last year showed gross wages of $16,640. Looking at the 4 results from the 4 income methods, there is no clear earning pattern. The loan originator or underwriter should investigate further to determine why significant discrepancies exist between the calculation methods and what figure should be used. Selecting the lowest figure without analysis is not acceptable. The selection must be carefully deliberated and may require additional verifications. After further analysis, the figure that is determined to be most representative should be used and documented. If no one figure stands out as the most representative, an average of the resulting figures may be used. Some questions that should be asked. Is B&N experiencing an unusual or temporarily large workload? Was Mr. Anderson absent from work for an extended period of time? Did Mr. Anderson recently receive a pay increase? Do his recent pay stubs include overtime earnings? Adjusted income is annual income less applicable deductions for which the household is eligible. Adjusted income is the figure used to determine program eligibility. This calculation must be below the low income limit in effect at the time of the ultimate recipiating draw request. Eligible deductions include a $480 dependent deduction for each household member who qualifies as a dependent. No dependent deduction for the borrower, co-borrower, or spouse. Reasonable expenses for the care of a minor, 12 years of age or under, that enable a family member to work or to further a member's education, are not reimbursed or paid by another source and do not exceed the amount of income earned by the family member enabled to work. A $400 elderly household deduction when the party to the note is 62 years of age or older, or an individual with a disability. Expenses related to the care of household members with disabilities that enable a family member to work are not reimbursed from insurance or another source and are in excess of 3% of the household's annual income. A medical expenses deduction may be taken for elderly households if the expenses will not be reimbursed by insurance or another source and are in excess of 3% of the household's annual income. The first deduction is the dependent deduction, which is $480 per household member that qualifies as a dependent. Dependents are members of the household who are not the borrower, co-borrower, or spouse, that are age 17 or younger, are an individual with a disability, or are a full-time student. A dependent deduction is applicable for any household member who qualifies under this section, regardless of how custody is shared. For example, the child need not be listed as a dependent on the tax return in order to be a household member for the program. A foster child, unborn child, or child who has not yet joined the family are not considered as dependents. For a full-time student, verify that the student is taking the minimum number of credits to be considered full-time for the school that they attend to receive the deduction by obtaining a copy of the school transcript. Reasonable unreimbursed child care expenses can be deducted for the care of children aged 12 and under if the child lives in the household, the care enables a household member to work, seek work, or go to school, no other adult in the household is able or available to care for the children, and the household member enabled to work has income that exceeds the expenses deducted. The limitation does not apply when the child care allows the household member to go to school. Any expenses paid by or reimbursed by a third party are excluded from the deduction. A single deduction of $400 is allowed if a party to the note is 62 or older or is an individual with a disability. In the case of a family where the deceased applicant or spouse was at least 62, the surviving family member shall continue to be classified as an elderly household if, at the time of death, the dwelling was financed by the agency, the surviving family member occupied the dwelling with the deceased member at the time of death, and the surviving spouse has not remarried. Certain forms of income, such as Social Security, may be used to verify the disability as opposed to requiring a doctor's statement. Be sure not to confuse the process for the elderly deduction with the dependent deduction. Remember, elderly household is a single deduction, so a household where the applicant and co-applicant are both over 62 or individuals with a disability will still only receive one deduction. Deduction for disability assistance expenses is the deduction for unreimbursed anticipated costs for attendant care or auxiliary apparatus, including maintenance costs, for each family member who is a person with disabilities. The deduction is for reasonable expenses in excess of 3% of the household's annual income, provided the expenses don't exceed the amount earned by the person enabled to work. The costs may be associated with the applicant to assist them to work, or it may be for the care of a household member which allows the applicant to work. Again, similar to the daycare deduction, this deduction cannot exceed the amount of earned income included in the annual income for the person who is able to work as a result of the expense. The key factor is determining what expenses are recurring so that you can project the next 12 months' expenses. To qualify for the deduction, the applicant must identify any household member with a disability on the application, describe the nature of unreimbursed expenses for that household member's attendant care or auxiliary expenses, provide documentation for the expenses, and demonstrate that the expenses enable an adult household member with or without the disability to work. If the household member receives a form of income as a result of verified disability, such as Social Security disability or disability compensation, that may be used as a method to verify the disability. Otherwise, have a physician or other medical professional verify the household member's disability. A medical expenses deduction may be taken for elderly households only if the expenses will not be reimbursed from insurance or another source and are in excess of 3% of the household's annual income. If a household qualifies for the medical expense deduction, expenses of the entire family are considered. For example, if a household includes grandmother age 64, her son age 37, and her granddaughter age 6, the medical expenses of all three family members would be considered. Remember, for annual and adjusted income, the income of all household members is considered. When determining repayment income, only the income of the note signer is considered. This is because the note signers are agreeing to repay the loan, so their income is used to determine the loan amount. Repayment income is projected for the next 12 months, similar to annual and adjusted income calculations. To be included for repayment, the income must be stable and dependable, meaning there's a history and it is likely to continue. A recipient with stable and dependable income provides more assurance that they will be a successful borrower. Repayment income is the income figure used in calculating the PITI ratio and the total debt ratio for repayment ability and the maximum loan amount. Keep in mind, repayment income and annual income may differ. Another common source of income to consider is the Supplemental Nutrition Assistance Program, or SNAP benefits, also referred to as food stamps, that are received by the applicant or co-applicant that do not exceed 20% of the total repayment income can be included as repayment income. The amount to include in repayment income is determined by reviewing the not to exceed amount and the actual amount received. If the actual SNAP benefits are greater than the not to exceed amount, the amount included in repayment income is the calculated not to exceed amount. If the actual SNAP benefits are less than the not to exceed amount, the amount included in repayment income is the actual benefits received. Guidance on including SNAP benefits in repayment income is in Handbook 1, 3550, Chapter 4, Paragraph 4.3b10. Please note that the worksheet for computing income does this calculation and evaluation of the not to exceed amount, for which you will be shown in a bit. On your slide, you will see an example of SNAP benefit calculations. The standard principal, interest, taxes, and insurance, or PITI, and total debt ratio limitations assume that the income is taxable. If the income is not subject to federal taxes, the amount of continuing tax savings attributable to the non-taxable income will be added to the applicant's repayment income. This is called grossing up. All non-taxable income will be grossed up to 120% for repayment income, except for SNAP benefits. Examples of non-taxable income include housing choice vouchers, Social Security, child support, or alimony payments if the instrument was executed or modified after December 31st, 2018. The basic purpose of grossing up is to put the non-taxable and taxable income on equal footing. Someone with $32,000 gross taxable income may get a $50,000 loan based on having $2,666 gross income per month to repay the loan, even though in reality they only have $2,000 per month net income after taxes. So by not grossing the non-taxable income up, someone with $24,000 per year non-taxable income who has the same net income of $2,000 per month as someone with $32,000 taxable is only getting a $40,000 loan. Only non-taxable income that will be included in repayment, meaning it was determined to be stable and dependable, can be grossed up. For example, if child support payments are not made as agreed or will end in the next 2 years, They are not stable income and would not be counted as repayment income in any way. However, if it was determined that the income was stable and dependable and it is being used as repayment income, then it will be grossed up. Repayment ability means applicants must demonstrate adequate and dependably available income. The determination of income dependability will include consideration of the applicant's history of annual income. An applicant is considered to have repayment ability when the monthly amount required for payment of principal, interest, taxes, and insurance, or PITI, does not exceed 33% of the applicant's repayment income. In addition, the monthly amount required to pay PITI plus recurring monthly debts must not exceed 41% of the applicant's repayment income. This is called the total debt ratio. If the applicant's PITI ratio and total debt ratio exceed the percentages specified by a minimal amount, compensating factors may be considered. Examples of compensating factors include payment history, if applicant has historically paid a greater share of income for housing with the same income and debt level, a savings history, job prospects, and adjustable for non-taxable income. If an applicant does not meet the repayment ability requirements, the applicant can have another party join the application as a co-signer, have another household member join the application, or both. Let's look at an example of how to calculate the ratio limit for a household with an annual income of $18,000. When divided by 12 months, that equals $1,500 per month. The principal and interest payment for the requested loan is $360. The real estate taxes on the property are estimated at $50 per month. Because the property is in a flood zone, it has an additional insurance premium of $10 per month, as well as a $50 per month in homeowner's insurance. The total PITI is $470. When the PITI of $470 is divided by the monthly repayment income of $1,500, the resulting ratio is 31.33%, which falls under the 33% ratio limit. Once the PITI is calculated, it is then added to the applicant's monthly debt payments to calculate the total debt ratio. In this example, the applicant has a minimum monthly credit card payment of $15, a $100 car payment, and a deferred loan with a monthly payment of $25 that will start in 10 months. The total debt is $610. When divided by the monthly repayment income of $1,500, the resulting total debt ratio is 40.67, which falls under the 41% ratio limit. The determination of whether or not an applicant's income is stable and dependable involves looking at the applicant's income history during the last 2 years and their income expectations for the next 2 years. Only income that is reliable and likely to continue is included in repayment income. The program does not have a minimum length of employment requirement. The historical analysis considers the consistency and pattern of income. It also considers the applicant's situation, such as multiple employers or seasonal or temporary employment with employers and routine periods of unemployment. In these situations, if the applicant's historical income reflects stable, similar income from year to year, the income may be considered dependable. In addition, there are cases where less than 2 years is acceptable. For example, someone new to the workforce or has returned to the workforce after an extended absence. If the applicant has gaps of employment in excess of 30 days, the applicant must provide an explanation, but the gaps in and of themselves do not necessarily indicate that the income is not stable. The concept is to focus on the history of income, history of employment, and whether the history demonstrates a reasonable expectation that similar income will be received in the future. Income from net family assets must also be included in the calculation of annual income. Applicants may be required to use non-retirement assets to make a down payment if the cash value of non-retirement assets is greater than $15,000 for non-elderly households or $20,000 for elderly households. Assets include cash on hand or funds in savings or checkings accounts, equity in real property and other capital investments other than the dwelling or site, amounts in trust accounts that are available to the household, stocks, bonds, and other forms of capital investments that are accessible without retiring or terminating employment, lump sum receipts such as lottery winnings, capital gains, inheritances, and personal property held as an investment. When calculating assets for the purpose of computing annual income, the cash value of all non-retirement assets of all applicants and co-applicants, as well as all household members, adults and children, are considered. When calculating assets for repayment income, only the assets of the note signers are considered, and actual income derived from the assets, which is determined stable and dependable, are used. Net family assets do not include the value of necessary items of personal property, such as household furniture, clothing, cars, wedding rings, other jewelry not held as an investment, or vehicles specifically equipped for persons with disabilities. While personal belongings are an asset, they are typically used for day-to-day activities like commuting to work or school or for recreational purposes, and therefore are not required to be considered as an asset for income or down payment. Assets that are a part of any business, trade, or farming operation in which any member of the household is actively engaged. For instance, a mechanic may own $20,000 worth of tools that are required to perform their job. As long as the applicant is working as a mechanic and is actively engaged in that trade, those assets would not be included because without them, they would be unable to work. The value of an irrevocable trust fund, or the value of a trust over which no member of the household has control. In this situation, the assets belong to the household, but they have no control to access the funds, so it is not considered. The cash value of life insurance policies. Interests in American Indian trust land. The value of tax advantages, health, medical savings or spending accounts, and college saving plans. And for income calculations, any assets on hand that will be used to reduce the amount of the loan. As an example, if the applicant had $20,000 in assets, and $5,000 of those would be used for a down payment, then only the remaining $15,000 balance would be used for the calculation of potential income. Retirement assets and income earned on retirement accounts for interest, dividends, or capital gains when funds can only be accessed by retiring, terminating employment, loaning against the account, or withdrawing with penalties is never considered as repayment or annual income. Let's move on now to talk more about site requirements in the upcoming slides. The primary requirement to this program is location. The property must be located in an eligible rural area on tribal land. Checking the rural areas part is easy with our online tools. On the USDA Income and Property Eligibility site, you first select Single Family Housing Direct. Next, select Property Eligibility, accept the disclaimer, and enter the exact address or drill down to find the property if the proposed construction or a newly built dwelling. Last, enter the address in the search bar or use the zoom feature to drill down to property location. Dwelling requirements for the program are discussed in 7 CFR 3550.57. To be eligible for a loan, all properties must be considered modest for the area, must not be designed for income-producing purposes, or have a market value in excess of the applicable maximum area loan limit. An exception may be granted on a case-by-case basis to accommodate the specific needs of an applicant, such as to serve exceptionally large households or to provide reasonable accommodation for a household member with a disability. Any additional loan amount approved must not exceed the amount required to address the specific need. Existing properties with in-ground swimming pools may be considered modest. However, in-ground swimming pools with new construction or with properties that are purchased new are prohibited. Existing dwellings must be structurally sound, functionally adequate, in good repair, or to be placed in good repair with loan funds, have adequate electrical, heating, plumbing, water, and wastewater disposal systems, and be free of termites and other wood-damaging pests or organisms. New dwellings must meet the construction requirements outlined in 7 CFR Part 1924 Subpart A. To be considered modest, the property must be considered modest for the area, does not have a market value in excess of the applicable area loan limit, meet the standard minimum square footage consideration of 400 square feet, and does not have certain prohibited features. The minimum standard area loan limit is 80% of the local HUD 203B limit in effect unless a higher percentage is approved by the Deputy Administrator of Single-Family Housing. These values can be viewed by selecting the link on the slide. The review process occurs once annually, typically at the end of each calendar year, shortly after the annual updates to the HUD's 203B limits are published. Area loan limits are built into the calculator. We will further discuss modest dwelling considerations in the upcoming slides. There are various dwelling features that are prohibited for loans made under the program. For example, an existing home with an in-ground swimming pool can be financed, but cannot be financed for new construction or for purchase new. If an existing property has an in-ground pool, it must be inspected. The property must not include buildings principally used for income-producing purposes. Farm service buildings such as barns, silos, commercial greenhouses, or livestock facilities used primarily for the production of agricultural, farming, or commercial enterprises are ineligible. However, farm buildings that are no longer in use for a commercial operation, which will be used for storage, do not render the property ineligible. Outbuildings such as storage sheds and non-commercial workshops are permitted if they are not used primarily for an income-producing agricultural, farming, or commercial operation. A minimal income-producing activity, such as maintaining a garden that generates a small amount of additional income, does not violate this requirement. Home-based operations such as childcare, product sales, or craft production that do not require specific commercial real estate features are not restricted. Accessory dwelling units, or ADUs, that include kitchen and bath areas and function as independent structures, commonly marketed as guest houses or backyard cottages, are ineligible. However, design features such as converted portions of existing homes that include a kitchenette or additional attached living area without independent utilities are not restricted, provided they function in support of household members only. Existing dwellings must be structurally sound and functionally adequate and be in good repair or be placed in good repair with loan funds. For an initial direct loan to purchase an existing dwelling or to refinance a non-agency loan, the recipient must engage the services of a state licensed inspector to perform a whole house inspection and provide a statement that the dwelling appears to meet the agency's DSS standards with respect to termites and other pests, plumbing, water and sewage, heating and cooling, electrical systems, and structural soundness. The inspection report must be a comprehensive document that meets the minimum standards of the Professional Home Inspectors Associations. When a state does not license inspectors, a qualified independent third-party inspector may perform the inspection and provide the necessary certifications. The NCDFI is responsible to obtain a property appraisal. Obtaining standard property appraisals on trust land can be challenging. Some trust land is highly remote without comparable sales or appraisers willing to complete the work. Additionally, appraisers can find it challenging to value the leasehold interest of the land underlying the home. In these areas, the sales approach is not required. Instead, Form 1007 Marshall and Swift Square Foot Appraisal Form must be used, reference Handbook 13550, paragraph 5.21. Consequently, in cases of new home construction, appraisals utilizing only the cost approach is acceptable. Most borrowers are required to maintain hazard insurance to protect the property against fire and weather-related damage. Hazard insurance is not required if the total outstanding NCDFI Relending Demonstration Program debt and any senior liens against the property are equal to or less than $15,000. After the loan is closed, the borrower must have an acceptable interest in the property per 7 CFR 3550.58. An acceptable interest in the property includes A. Fee simple ownership. Acceptable fee simple ownership is evidenced by a fully marketable title with a deed vesting a fee simple interest to the property to the borrower. B. secure leasehold interest. A written lease is required. To be acceptable, a leasehold interest must have an unexpired term of at least 150% of the term of the mortgage, unless the loan is guaranteed, in which case the unexpired term of the lease must be at least 2 years longer than the loan term. In no case may the unexpired term be less than 25 years. C. Life estate interest. To be acceptable, a life estate interest must provide the borrower with rights of present possession, control, and beneficial use of the property. Generally, persons with any remainder interest must be signatories to the mortgage. All of the remainder interest need not be included in the mortgage to the extent that one or more of the persons holding a remainder interest are not legally competent, and there is no representative who can legally consent to the mortgage, cannot be located, or if the remainder interests are divided amongst such a large number of people that it is not practical to obtain the signatures of all the remainder interest. In such cases, the loan may not exceed the value of the property interest owned by the persons executing the mortgage. D. Undivided interest. All legally competent co-owners will be required to sign the mortgage. When one or more of the co-owners are not legally competent and there is no representative who can legally consent to the mortgage, cannot be located, or the ownership interests are divided among so large a number of co-owners that it is not practical for all the interests to be mortgaged, their interests not exceeding 50% may be excluded from the security requirements. In such cases, the loan may not exceed the value of the property interest owned by the persons executing the mortgage. And E. Possessory rights. Acceptable forms of ownership include possessory rights on an American Indian reservation or state-owned land in the interest of an American Indian in land held in severally under trust patents or deeds containing restrictions against alienation, provided that land in trust or restricted status will remain in trust or restricted status. Adequate security. A loan will be considered adequately secured only when all of the following requirements are met. 1. A mortgage is obtained at closing on all ownership interests in the security property or the requirements of 7 CFR 3550.58 are satisfied. The mortgage represents the NCDFI's security in the property. 2. No liens prior to the NCDFI mortgage exist at the time of closing, and no junior liens are likely to be taken immediately after or at the time of closing, unless the other liens are taken as part of a leveraging strategy or the NCDFI loan is essential for repairs. Any lien senior to the NCDFI lien must secure an affordable non-CDFI loan. Liens junior to the CDFI lien may be allowed at loan closing if the junior lien will not interfere with the purpose or repayment of the CDFI loan. When the junior lien involves a grant or forgivable affordable housing product, the total debt may exceed the market value provided. The CDFI loan is fully secured with allowable exceptions for the tax service fee, appraisal fee, homebuyer education fee, and initial escrow for taxes and insurance. The junior lien is for an authorized loan purpose identified in 7 CFR 3550.52, and the grant or forgivable affordable product comes from a recognized grant source, such as a community development block grant or a home investment partnership program. 3. Title insurance is not necessary for loans on tribal trust land, as the Bureau of Indian Affairs will manage and certify all transactions and will provide the certified title status report in place of the final title insurance binder. And 4. Existing and proposed property improvements are totally on the site and do not encroach on adjoining properties. To request funding for an ultimate recipient loan, remit the NCDFI Relending Demonstration Program Ultimate Recipient Application Checklist with applicable attachments to rural development. Unfortunately, only paper checks from the U.S. Treasury are available for payment. Please allow time for the checks to mail to rural development and then again to the NCDFI. The NCDFI may use other funds to close the loan once the check has been ordered. The NCDFI should not close the loan until rural development has advised them that the check has been ordered. The request to attachment to the checklist will include A. The loan application. Information on this document will be used by the rural development representative to pull the Do Not Pay report and complete the environmental review. B. The 4A worksheet for computing income and maximum loan calculator used to document the income calculations. And C. The Tribal Historic Preservation Office property review and sign-off. This is not applicable for new properties. NCDFI Relending Demonstration Program recipients are required to submit quarterly reports to Rural Development due 30 days after the end of each quarter until at least 90% of the agency loan funds have been advanced to ultimate recipients. Thereafter, reports will be required semi-annually. USDA may require quarterly reports if the NCDFI becomes delinquent in repayment of its loan or otherwise fails to fully comply with the provisions of its work plan or loan agreement, or the agency determines that the NCDFI Relending Demonstration Program Fund is not adequately protected by the current sound worth and paying capacity of the ultimate recipients. The servicing report shall contain information on the NCDFI Relending Demonstration Program Loan Fund, including lending activity, income and expenses, financial condition, and a summary of the ultimate recipients financed. When other funds are included in the reports, the NCDFI Relending Demonstration Program portion shall be segregated from the others. Sign up for GovDelivery to receive email updates on the Single Family Housing Direct programs. Using the link on this slide, enter your email and select Single Family Housing Direct Loan and Grant Programs and any other programs of interest, and then click Submit. This email subscription service is used to provide updates regarding changes to the following: Section 502 Programs Interest Rate, Handbook 13550, the Certified Packaging Process, and much more. Thank you for joining us for this webinar.